Students, this is a second lecture about quantum, but this time it's about quantum finance. We are fintech students, we're finance students. I hope for fintech because, come on, we're become to be technology now. So quantum finance. Why it matters for finance? Risk is inherently quantum-like, uncertainty, probabilistic. Quantum foundation help us with complex dependencies. Nonlinear risk structure usually in finance is linear, in fintech nonlinear, and most of the problems are nonlinear. And new optimization pathways. What is quantum finance and why now? Quantum finance is the study of application of quantum computing principles, financial modeling, asset pricing, risk analysis, portfolio optimization. Why now? Well, quantum finance, why now? So you see a lot of asset classes like IBM, Google, Rigetti, and other companies trying to develop a quantum computer. And if you look to these computers, going to be with the bigger capabilities. But why we need the capabilities? Because as I mentioned in previous lecture, in 2000, we have about 23,400 security traded every day. Now we have a 79,700 traded every day. It's 3 times. So 20 years from now, it's going to be another multiple. So we're going to have a 250, 300,000 security traded. So the computers, the capacity of these computers are developed by Rigetti, IBM, and Google. The classical computers cannot handle this number for optimization, simple optimization. So you need a bigger computers to handle this. So for example, if you want to do the key theory in finance, which is the mean variance, maximize the return for a given risk. Well, with the classical computer, when you have a 700,000 security, you cannot do it as of today. You cannot do it. But with the quantum, you can do it. So you already, even now, you still need a quantum. You need a quantum to do this optimization, maximize the return for a given risk. And look at the companies who are doing quantum computer companies. Look, for example, Qubits, which is a D-Wave, 1,800%. I have Inox, 1,300. Rigetti, 425 in 1 year. These companies. No, Rigetti is more. Rigetti is 1,342, and Inox is 425. So the core idea is a traditional finance uses classical probability and computation. Quantum finance is a quantum probability, which is amplitude based in a qubit-based computation. So we use superposition to optimize the problem. So for example, if you do a comparison probability, classical probability, here we have a quantum probability, which is amplitude. A mean variance, we're going to go through algorithm like somebody like a Shor's algorithm. Classical Monte Carlo, quantum Monte Carlo. So everything will be transferred. So this is a different world. Quantum finance in action, portfolio optimization will be explore exponential combination faster, entangled, like how two assets can be correlated, speed, machine learning is going to be better, and analyze the quantum resistance. For example, in optimization in classical computer, you input data, you put the companies, formulate the problem, maximize return for a given risk, solve the problem, get optimal solution. Here is different. You have more data encoded into qubits, and then you can get the optimal solution. In Monte Carlo, the same. You encoded the payoffs, and you get more results. If you do Monte Carlo, always you have a different iteration, you have a different numbers. With the quantum will be more rigorous and more stability outcome. So, what's going on with the institutional versus retail? Recently, the retail became to be big with the rise of Robinhood and Schwab. But we believe that quantum computing will widen the gap between institutional and retail because the early access of the quantum will be more for institutionals than retail. That's the reason I want to have a master's in fintech to close the gap. If you are an investor, you don't want to work for an institutional company, you want to have your investment company. So I want you to know some technology and have access to technology that you can have it only with the institution. The quantum computer computing gonna break the 60-40 paradigm. What is that 60-40 paradigm? As of now, there is something called passive investing, which is basically you buy an ETF ready. It's 60% S&P, and then you buy a couple bonds, and I will call it 60-40 paradigm, like 60% of your money in the S&P and 40 in the bond. With the quantum, we're gonna break this. It's gonna be shift from this 60-40. You maybe go to 80-20 or 90-20, 90-10, because the risk and uncertainty will be more measured and more learned about it and more insightful about it. Also, we're gonna disrupt the ETF business. We're gonna have a different ETF type of models. Over here, I have a key quantum machine learning method in finance. So I explained that. If you are in AI class, quantum support vector will use a quantum kernel. And this is the example. Advantage is handling high dimensional data effectively. Now, hybrid quantum classical models combine classical with the processes with the quantum circuits and practical for current quantum hardware. Now I'm going to move to valuation, how to evaluate a quantum company. Most of the quantum companies are losing money, basically. You get, for example, Rigetti. This is a great company. I invested a lot of money. I make a lot of money with this company. So this company has, you can look at what happened 1 year. This is this that I showed you. But if you go here, you look what happened 1 year. See, we got 937%. But if you go to statistics, you can see they didn't have a PE ratio because they're losing money. So sale is this, market cap 5 billion. So if you go to the financials, the revenue, total revenue 900, so it's in thousand here. It's about $92 million, not much. So how to price these companies? You have to look how much the R&D intensity, R&D research and development, revenue growth, strategic value, IP patents. I'm going to teach you QFI, Quantum Finance Index, where we go through this one patent, speculation, innovation signals, see how NVIDIA interact with them. Valuation challenges, if lack of earnings, not a lot of earnings, patent and tech breakthrough are hard to price. So innovation-driven valuation metrics, the way to do that, patent usually. The talent they hire, you can see that from LinkedIn and job trend, collaborations, with what they collaborate with whom. Google trend, public interest in this company. I also did that with the QFI. Looked at the QFI index for this company. So you will see that. Sample evaluation technique. So the method, real option analysis, value flexibility, and certain tech development, scorecards, weight, IPA, leadership, ecosystem, innovation premium model, and scenario-based DCF, discounted cash flow. Case study I did with this company, Ionix versus Rigetti. So you can see the patent, Rigetti about 80, Ionix 180. Google trend, you can see low, but this is getting more exposure recently. Revenue, how much? Market cap. Now the market cap become to be more, 5 billion, and this is more also. Key takeaways, valuation, quantum pioneers requires blending in finance, tech, and foresights. And then quantum valuation is a frontier where finance meets emerging science. Here are your homework. You have 10 questions. I want you to answer these questions toward the end. Again, this is quantum finance. What is it? What it matters? Why? What is quantum finance? Is the study and application of quantum computing principles to financial modeling, asset pricing, and portfolio optimization. And why we need that? Because asset classes become to be wide, like a crypto. Now we have 12,000 coins traded. Before we didn't have. So you cannot use classical computer to make the optimization. Thank you so much. I hope you enjoyed this lecture about quantum finance. Please answer the 10 question. Thank you.